Good afternoon and welcome to the TEKMAR Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And now I'd like to hand you over to Alistair McDonald, CEO. Good afternoon, sir.
Thank you, Lily, and good afternoon, everybody. We're delighted to be presenting TEKMAR Group's investor update to you today. And if we can move on to slide 3, which is a presentation on the agenda. With you from TEKMAR are myself, Ali MacDonald. I was chairman from 2013 and more recently Group CEO since October 2020. I'm joined today by Leanne Wilkinson, CFO, who has been with TEKMAR in senior finance roles since she joined TEKMAR in 2020, and the board as CFO since June 2023. Our aim today is to give you an update where TEKMAR is as a business after a transition period where we are focused on positioning the group for consistent EBITDA growth. Now we are seeing the market in a period of an evolving energy landscape, and why we are confident and optimistic about the group's prospects in the near term and beyond. Moving on to where TEKMAR is today, we are very much in a stronger position than we were 2 to 3 years ago. We have successfully stabilized the business and returned TEKMAR to profitable growth. Last week, we were pleased to report results with our highest level of adjusted EBITDA for 4 years, with a gross margin of 33%. We have a balanced portfolio of businesses across offshore wind and energy transition, with our near-term growth prospects well aligned with the positive fundamentals in both of these markets. We benefit from a relationship with SEF Partners, our strategic partner and shareholder. SEF have helped to drive our growth ambitions, stabilize our balance sheet, and provide additional firepower to support our shared M&A ambitions to drive transformational growth. Our medium to long-term outlook is supported by exponential forecast growth in offshore wind, which we will cover in this presentation. As we build out our first-class offshore wind services platform over time, we will benefit from these structural tailwinds. Now reflecting on our key milestones in building the business we have today. We have always been pioneers in the offshore wind markets, and TEKMAR was founded in 1985, representing a near 40-year track record. Our IPO in 2018 gave us the opportunity to diversify our portfolio, acquiring PipeShield later that year, which has been a consistent profit generator for the group and a great acquisition. We have also built out our consultancy capability, allowing us to benefit from early engagement on key projects, and we have continued to invest in our leading offshore wind protection capability. In 2019, we were one of the first companies to be awarded the London Stock Exchange's Green Economic Mark, highlighting our sustainability credentials. I stepped in as CEO in 2020 and looked to fundamentally strengthen the business, making TEKMAR more consistent with stronger and more robust engineering and commercial management discipline. We did this during a challenging period through COVID and its aftermath, with market-wide challenges around global supply chain, cost escalation, funding issues, and uncertainty over energy infrastructure project economics. As a business, we were delighted to welcome SEF as a strategic partner in 2023, who share our ambition to build a leading global offshore wind services business over time. The partnership with SEF is a major catalyst for TEKMAR to accelerate growth, and their track record in building successful energy services and technology companies is a major advantage for us. Most recently, in H1 to March 24, we delivered significant adjusted EBITDA improvement and completed the disposal of our subsea innovation business, which allows us to build a stronger platform for TEKMAR for more consistent profit growth in line with our strategic plan. Moving on to our integrated platform. This slide illustrates the compelling shape of our engineering, technology and services capability today, spanning the offshore energy project cycle. Our consultancy services gives us valuable early visibility on projects and early engagement with customers on key projects. TEKMAR Energy and PipeShield are the primary profit generators of the group, with TEKMAR Energy returning to a positive adjusted EBITDA contribution in the first half of the current financial year. This continued improvement is fundamental to the group delivering sustained EBITDA growth, complemented with ongoing consistent and growing earnings from our PipeShield business. We have shared customers across our portfolio with a complementary diversified offering across the energy markets. Moving on to customers. This slide gives us an overview of the quality and breadth of our customer base, and we benefit from very strong relationships with energy companies, Tier 1 contractors, as well as manufacturers. With the increasing volume in the market and the greater engineering complexity of offshore wind projects, we are now seeing more reliance on technical know-how and strategic partnerships in order to support the delivery of global projects. From TEKMAR's perspective, with our integrated model, our complementary technologies and track record, we help to de-risk, optimize, and improve project economics for customers in a dynamic and technically challenging offshore environment. In this regard, we are a trusted partner on leading global major energy infrastructure projects, including, for example, Dogger Bank, the wind farm with Demi Offshore and SSC, where we're actively supporting the delivery of the world's largest offshore wind project at 3.6 gigawatts. Last year, we supported the successful delivery of the Vineyard Wind project, one of the first major projects in the US. In addition, we have a strong track record in the developing Asia-Pacific market outside China, where we have engaged with customers on a number of wind farms, which are the first major projects in their respective countries, including Japan, Taiwan, and South Korea. We see European technologies and know-how remaining the vanguard to enable delivery of these projects in these regions. We see Asia-Pacific as a particularly exciting region for us. We are also benefiting from a maturing alignment with customers, partners, and developers in order to deliver the significant market ambition and growth, which we'll outline in the next section. Moving on to the market. The offshore wind market continues to strengthen as energy markets are aligned to the commitment of the United Nations Global Coalition for Net Zero Emissions by 2050. Despite recent headwinds, strong growth in offshore renewables is expected through 2030 and beyond, at 261 gigawatts and 758 gigawatts respectively from the current 70 gigawatts installed base. We are seeing political support strengthening in support of this significant ambition. Moving on to the outlook for 2030. Global capacity, as I said, is forecast to reach 261 gigawatts being installed or underway by 2030. From a commissioned capacity of 70 gigawatts today, we have previously mentioned. Looking more specifically at some of our key markets, Europe is set to increase capacity from 33 gigawatts currently to 124 gigawatts, representing a 3.8 times increase. Asia Pacific outside China is set to increase capacity from a low base of 3 gigawatts to 32.5 gigawatts, a 10 times increase. With America's increasing capacity from a very low base of 0.2 gigawatts to 27 gigawatts. This represents significant growth, demonstrating a global 2 to 4 times increase by 2030 in half the time it has taken the market to deliver 70 gigawatts. We now have visibility of over 300 projects, and with a strong track record of securing projects in these regions, we are well positioned to benefit from this future growth. Moving on to the near-term market environment. Instability and uncertainty in the offshore wind market has been a feature in the last couple of years. We are now in a phase of market improvement with a record year for final investment decision approvals in 2023, with this continuing into 2024 in line with the market projections. This positive trend needs to be caveated in the near term, as we are still seeing uncertainty with timing and phasing of project awards as the supply chain aligns to growing market demand. Alongside this recovery and the projected demand for offshore wind over the long term, we are positive on the outlook for growth in our offshore wind business. Moving on to the global energy transition. The need for a balanced energy transition is resulting in significant investment across all energy sectors. The offshore energy transition market is expected to grow by 21% through 2023 to 2028. You can see we are in a sustained period of higher capex in the energy transition market. This is particularly important for our pipe shield business, which benefits from growth in this market. Overall, therefore, we see a very favorable outlook for all key end markets. Let's now look at what we are doing to position TEKMAR to achieve sustained earnings growth against this backdrop. As you will have seen from a recent market update, we reported good results with a gross margin of 33%, up from 28% in H1 and 20% in H2 2023, demonstrating improvements as a result of our transition action plan and improved commercial discipline. Leanne will now comment with further detail.
Thanks, Ali. The company performed well in the first half of 2024, achieving adjusted EBITDA of £1.8 million. This marks a major milestone for TEKMAR Group as our highest level of trading profitability for 4 years and represents a substantial £1.8 million increase from the prior 6-month period. One of the key drivers behind this achievement is the margin improvement we have made, attaining a gross profit margin of 33% and a return to double-digit EBITDA margins. Also, fundamental to these results is the return to profitability of our offshore energy division, which is largely offshore wind and generated £1.4 million in EBITDA during this period. Restoring our offshore wind business to improve profitability and growth is fundamental to driving sustained EBITDA growth for the group. Combined with the consistent profit generation of our marine civils division, which is effectively our pipe shield business, which delivered £1.5 million, we now have a stronger and balanced platform for growth. Another significant aspect of our performance is the higher quality of our order book and order intake. Our order intake at the half year totaled £24 million, which was achieved at a commendable blended gross margin of 31%. This reflects our success in securing high quality projects with improved terms and milestone payments. Ultimately, this comes down to better management of projects and a more robust commercial approach generally. As we continue to build better quality and de-risked order book, this supports our objective of returning the business to sustained profitability. Cash flow and liquidity has been a major focus for the business over the last 3 years. The strategic investment and partnership with SCF Partners was a fundamental step in stabilising the business, and we also appreciated the support more generally of our investors with the fundraise we completed last year. We remain focused on a disciplined approach to cash, debtor collections, working capital management, and improved cash generation. We reported a significant improvement in operating cash flow for the interim period, which was around £3 million better than the previous period. We are currently in discussions with our relationship bank relating to the renewal of our existing trade and Seabills facilities, with these discussions progressing in line with planned timeframes for renewal in 2024. An important marker of our rigorous approach to managing the portfolio was the disposal of Subsea Innovation, which we completed earlier this month, from an aggregate cash consideration of £1.9 million, with TEKMAR Group also retaining the freehold for the property. The cash proceeds will be available to support the group's near-term growth priorities and for general working capital purposes. Subsea Innovation had struggled to deliver consistent profitability, and the divestment sees 38 employees transferred to Unique Group and in turn strengthens TEKMAR's core business and improves revenue visibility and earnings consistency. We're also adopting a measured approach to CapEx and investment in the core business, aligning our resources to opportunities which provide greatest near-term benefits. We expect CapEx for the current financial year to be in the region of £2 million, with approximately half of that covered by investment in strategic initiatives, including product development of our core TechLink cable protection system and investment in grouting services and marine civils in support of near-term revenue growth for Pipe Shield. Our grouting investment helps us build on our strong capability in the Middle East, where we secured £50 million of order intake for FY23 and £10 million to date in FY24. We have identified a number of other strategic investment opportunities, with funding of these initiatives subject to phasing as cash flow builds to support the required investment. If we move on to M&A, with the path to profitability established and the core platform streamlined with the disposal of Subsea Innovation, we are pursuing M&A opportunities to complement our organic growth. This includes opportunities to build scale, quality of earnings, and stronger free cash flow through strengthening the technology and services we offer to our customers. The ambition is to build a leading global offshore wind services company over time. Consistent with this, we are alert to the potential value in acquiring capability that can transition to servicing the needs of the offshore wind industry as it matures and evolves. Building a stronger platform should in turn create a business which the stock market can value more highly. Furthermore, we benefit significantly in this M&A context from having SCF as a strategic partner, where we can leverage their complementary industry knowledge and investment expertise to help source and execute value-enhancing acquisitions. We also benefit from SCF's committed £18 million funding through the convertible loan note instrument, which remains available and is targeted to be deployed primarily for value-enhancing M&A and strategic growth. Moving on to key performance indicators. Our KPIs highlight that the objective of stabilising the business has been achieved. We delivered £1.8 million of adjusted EBITDA on £16 million of revenue. This was a £1.2 million EBITDA improvement on the comparative period, despite flat revenues. The gross margin of 33% is also a key marker of improvement, as was the return to profitability of our offshore wind business. We've talked a lot over the last 2 to 3 years about transition and turnaround. Now the business is ready for growth. I'll now hand over to Ali for some concluding comments.
Thank you, Leanne. And to conclude, I would like to summarise our view on current trading and outlook. H1 2024 represented a very satisfactory set of numbers for TEKMAR, and we expect another period of positive EBITDA in the second half, with full year 24 overall representing a significant improvement in trading profit over the prior year period. Looking further ahead, our confidence is supported by the strong structural growth in our end markets and the opportunity we have to grow volume at acceptable economics. Having positioned the business for growth, we are also looking at M&A to accelerate this growth, working with SCF as our strategic partner to deliver on significant opportunity to build a business of real scale and global capability with compelling fundamentals for investors. Finally, we would like to thank you for your time today, and we will be delighted to take your questions.
Alistair, Leanne, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the right-hand corner of your screen. We received a number of questions today, both pre-submitted and throughout the presentation, and I wanted to start off the Q&A session with these. The first one reads as follows. How do you see demand in the US for offshore wind energy? Does it have bipartisan support?
Let me take that one, Leanne. So I think the US market, I think we've all seen the headlines that it's been a bit of a stuttering start, to say the least. We see significant volume developing in that market. It's very compartmentalized. I think that's where I would say there's probably a bit of a pause in the short term. We're really focused on the established European market, the Asia Pacific market, which largely will benefit from known technology that we've been active in for since the time we were involved in offshore wind. So we've got a very strong foothold and a lot of experience in this space. So I think it's adoption and expansion of the technology. I think the US market will probably be on a bit of a hold for the next couple of years as we see the supply chain developing over there. Our ambition is still to have presence in the US market to continue to support developers similar to what we've done on Vineyard Wind. So we see the US market growing probably more in the next 3 to 4 years, i.e. past the first year 1 to year 2, that's a 3 to 4 year timeline. So that's really why we're kind of in the short term more focused on the European and Asia market. The US market will come. But there's a lot of learning and development and maturing that we still need to see first, including developing of the supply chain, capacity, vessels, cable manufacturing, etc. So that's our outlook on the US market. It's more a mid-term play for us rather than a short-term play.
Thank you. The next question here reads, can you please help us understand the competitive landscape and TEKMAR's unique offering? Is your latest cable protection system price competitive with Chinese alternatives?
Yeah, so the competitive landscape I see is maturing. I think, as you've probably seen from the presentation and market news, I think there's an accelerated maturing in this market. The technology evolution, I think, was oversimplified. I think there's been a lot of learning which we benefit from supporting our customers in delivery of improved technical solutions for more complex offshore projects. So I think from a competitive landscape, we see it stabilizing out in amongst some key suppliers who have invested very strongly in the technology offering. So it's kind of moved up from a kind of a technology know-how. These environments are very complicated. And one of the benefits we see within the TEKMAR group is that we have complementary technologies, which is unique to TEKMAR group. The competitive landscape is largely more fragmented, I would say. And our strategic direction is to align more of these technologies to support the growth we see in the market. So we see it as a very balanced competitive landscape supported by increased volume. I think one of the benefits we've seen over the last year is we've been more selective in our tendering process, looking for a more equitable risk-reward balance where we can see delivery of returns. and I think the market supports that. In terms of the Chinese landscape, we have a presence in China, which we've benefited from, but largely the China market is at the very top end of the market, where there is a pricing differentiator for more complex technology. We see the kind of commodity end of the market in China is very largely isolated to the internal supply chain in China. We don't see the China market supplying outside of China as a result of that simplified, more commodity play. So that's where we kind of talk about the Asia Pac market, excluding China. It's a very selective strategy for us in the China market, and largely outside China, the competitive landscape is from businesses that have got a quite significant investment and understanding of the technology need for these kind of complex solutions that we're working on.
Thank you. The next question here reads, it's clearly encouraging and necessary to see the return to profitability of the TEKMAR Energy offshore wind business. What's your confidence this can be sustained?
Yeah, and as we've alluded to in the presentation, the last 2 to 3 years has been very focused on operational efficiency. We've been supported by some partners that have helped us to introduce best practice to deliver the returns and effectively deliver what we said we're going to deliver. So yes, it's comforting to see that work has paid off, and we've got the offshore wind business now contributing to the performance in the business, which complements the continuing good earnings we've seen from the pipe shield business. We still see opportunity to add volume to that business, and having addressed the kind of underlying performance of the business, there is a lot more efficiency we can introduce into that business with increased volume. And as we've demonstrated with the growth in the market, it's pleasing to see that we're now seeing that market opportunity converted into the highest inquiry we've ever had. So I think it's supported by a number of areas: bottom-up efficiency, operational excellence, top-down market maturity, transferring into inquiries, and also seeing better contracting terms and a more equitable risk-reward balance that allows us to generate cash and reinvestment for the technology of the future to move into even more complex projects such as floating wind, which is on the horizon.
Thank you. The next question here reads, these are good results. Your guidance for the second half seems pretty cautious as an improving market. What is your guidance for the second half of the year, and why is it more cautious than the first half?
Yeah, I think on the guidance, as I said, the market is very promising. I still think we see a bit of timing uncertainty, partly driven by our own demand to have better commercial risk terms, commercial terms, payment terms, etc., etc. So we are taking longer to negotiate these contracts, and that's what gives us a bit of uncertainty in the short term. And we've improved, obviously, what we're in control of, which is the operational efficiency. What we're not in control of is the timing of these projects. So that's the only real issue why we've put a bit more cautiousness into the market. We're still very optimistic in terms of the second half being positive and the overall full year being positive. But we're still just a bit cautious on timing. We really didn't want people to kind of take the H1 numbers and just double them. There's still a bit of uncertainty around the market, and therefore we just didn't want to be overcommitting at this stage. So we're really kind of taking a cautious view in the near term.
I think also, Ali, to add, in H1 there were a couple of factors around variation orders on large projects, which was really timing that may not be repeatable to the same extent in H2, depending on the projects. So that also added to us being cautious on H2.
Thank you. The next question here reads, the challenges of the offshore wind industry have been much trailed in the media. What's changed in the market to support your confidence given interest rates remain high and they may be higher for longer? Is it government support, and if so, what are they doing and what are the risks to that?
Yeah, I think government support is a big factor. I think as we talked about we're starting now talking about beyond 2030. Whilst we see a lot of ambition in terms of 261 gigawatts by the end of the decade, which is effectively, if you take a conservative view, it's doubling from the current capacity of 70 gigawatts. You take the optimistic, it's 4 times scale by the end of the decade, and even beyond that, we're now seeing 760 odd gigawatts. So, in terms of the ambition to meet this global commitment, I think there is a lot of ambition from the government. We're also seeing the strike price, which has really been holding back this market, that the pricing level for return in the supply chain has just been too aggressive. We see adjustment in the strike price, the guaranteed price in the UK. We've seen the same in the US market. So I think that bodes well to support investment and for the supply chain to develop. So I think all of the above is coming together to kind of give us this level of confidence that certainly the market has improved. There's still a bit of improvement to go. As we say, we're trying to get better terms to give us more control of the outturn. We've moved the dial in that direction, but there's still a bit to go. But definitely we're seeing this offshore wind market moving in the right direction.
Thank you. The next question here reads, you came to the market with a dominant market share in cable protection. You mentioned a few years ago that competition was increasing. What's happening to your market share and to pricing? How competitive is the market?
Yeah, so I think for the longer term investors, you've seen this business talking a lot about market share. Since Leanne and I have come on board, we've kind of moved away from talking about market share, really to focus more on earnings and cash generation and being more in control of this kind of risk-reward balance that I talk about. But to answer the question directly, our market share is holding up, but we're not really driven by market share. We're more driven by taking on business that we can control, and therefore we get better earnings. I think that's also supported by the increasing volume. When I came on board as CEO, I did talk a bit about competition is normal in a growing market. And what I'm pleased to see is that the competition in the market has a level of discipline also that is supporting this kind of confidence that it is a maturing market and a market to play in. So I think I'm still very encouraged that the opportunity and the scale we're seeing in the market is going to support the growth of the business going forward from an organic point of view and supporting us to invest in complementary M&A technologies.
Thank you. The next question here reads, what's driven the improvement in gross margin for H1? What should we think of as normalised margin for the business, given PipeShield and TEKMAR Energy are different types of businesses?
Maybe I'll let you take that one, Leanne.
Yeah, thanks, Sally. So we talked in particularly in our FY23 year-end results about, last year we continued to have a couple of low margin backlog projects running through. The impact of those is diminishing. There's one that runs on into early 2025. But as we add additional volume at improved margins, the impact of that diminishes. We also in H1 this year, we've put a lot of effort as well as the wider business improvements, which we've talked a lot about. We've put a lot of effort into supply chain initiatives. So that's gave us a benefit in H1. And as I just alluded to a little earlier, we did have some variation opportunities on a couple of large contracts that completed. Going forward, we believe late 20s is sustainable. The late 20% is sustainable, and that's certainly what we'll be aiming for. And just to circle back on an earlier question to link to that, we have confidence in our delivery now. We've executed projects over recent months, and we delivered the margins that we expected. And that's why we have that ongoing confidence in the margin that we have on the recent order intake.
Thank you. The next question here reads, what's happening with the debtor book, and does that cause you any concerns?
I'll take that one if you like, Ali. So our debtor book overall is quite tidy. We have, there's a couple of regions and limited to a small number of customers where we see extended terms. We work closely with those clients and have kind of a clear visibility of those payment plans. So we don't have any overall concerns, but we just put our effort into recovering those debtors in those areas and with those clients, as soon as we can, really. But overall, we're that's another area over the last few years where we've put a lot of effort in, and we've seen a lot of improvement.
Thank you. The next question here reads, the adjusted EBITDA figures in the interim suggest marine civils is a more stable business than offshore energy. Is that what it has been over the last 5 years?
Yeah, so just to take Marine Civils, which is our pipe shield business, so that joined the group in 2019 and has been a really successful acquisition for us, growing and consistently delivering on its projects and on kind of the bottom line, the adjusted EBITDA. So we're very pleased with that acquisition and how that business has developed. TEKMAR energy within the offshore wind area, that has had a more difficult and challenging few years. But there was a slide in our presentation that kind of takes you back to, I think it was March 20, which shows the performance of the business pre kind of COVID. So certainly that side of the business, the offshore wind side, has had a difficult few years, mainly by the market. We've also took some, the opportunity to significantly improve our business processes and commercial side of that business. So now we have that back to where it should be performing, and with the wider context of the business improvement processes and the volume coming back in the market, we believe that business is back, turned around and, sustainable margins going forward.
Thank you. The next question here reads, given the lengthy delay in collecting receivables in China and the constraints you have on your working capital position, are you bidding for more business in China?
Yeah, do you want me to take that one then?
Yeah, go for it.
Yeah, so as we all know, China's a key market, but it is a difficult market to make returns from. So we've taken a view that we will still participate in the China market, but on a very selective and targeted basis, primarily focusing at the top end of the market where there is a price differentiation on technology know-how. So going forward, it'll be more selective, and getting cash out of China remains a challenge. And we feel there are more lucrative markets to go as we see this volume maturing in the market, where we can be more assured of generating cash returns. So in summary, yes, but on a very selective and targeted basis in the China market.
Thank you. The next question here reads, I note you see CapEx this year at 2 million compared to the 1.2 million and under 1 million in each of the last 2 years. Can you give us some context for this?
Yeah, I mean, that's purely just been, due to affordability and cash flows. So obviously, as the business returns to profit, we obviously look to step that up. We have plans there around our, where the business can go through some, I would say, quite moderate investment, but we're just taking quite a cautious approach. Our aim is to step that up this year, but like I say, quite a cautious approach and phased approach with, with our cash flows available to us currently.
Thank you. The next question here reads, when do you anticipate getting the SIL 1.4 million trade receivable?
We would expect that probably in the next quarter.
Thank you. The next question here reads, thanks for the presentation. You indicate a current order book of 24 million. Given the number of projects you indicate you have visibility on and the structural growth in the end market, are there key opportunities in the pipeline that could inflect that order book, and what are the timelines on those opportunities?
Yeah, so yes is the answer. a number of significant contracts coming to the market. So we do see, upside in terms of that volume of order book and backlog. What we're not so sure about is the kind of timing of these large contracts, so hence supporting our cautiousness that we've reflected upon for H2 and commented on for H2. What I would say, though, is that to address this volume in the market, the whole industry needs to have a much quicker cycle. We're still going through a lot of learning in terms of the technology need, maturing of the market, as I call it. I think the timing of that negotiation is taking a long time, but we are seeing a need in the market to progress and develop partnerships so we can cycle contracts. So the reality is these 260 gigawatts we got by the end of the decade will not work unless we align better as an industry. What I'm pleased to see is that we are seeing more partnerships, early engagement, developing, for example, what's happening in the Asia market, which we're very active in projects that are well ahead of us in the pipeline in order to understand the technology fit sooner rather than later, rather than negotiating back of a live tender process or live on projects. So the cycle needs to accelerate and mature, and the industry is starting to move in that direction. So we see partnerships as being key as we go forward. And I think that bodes well in terms of our current offering, our aspirations regarding bolt-on M&A technologies. And I think that will help the kind of market start to deliver quicker turnaround projects. So a bit of an answer there, short and mid-term in terms of the projection, but we are seeing much larger contracts coming through the pipeline now, which is encouraging.
Thank you. The next question here reads, can you please also talk about the price aspiration of those you are seriously considering within your M&A pipeline, as you indicate you will use that to accelerate company growth? What IR hurdles will you use to make those inorganic investments?
Yeah, I think, I'm not going to comment on pricing in the M&A market for obvious reasons. But really what we're looking at is focusing on profitability. We are looking at opportunity to scale up the business. It's really around quality of earnings, and really it's around that enhanced technology complementary fit in order that we have an even wider one-fit solution for these projects. So that's principally our M&A rationale and strategy, but I'm not going to comment on the detail of pricing. I think that was a comment in the question there.
Thank you. And the last question we've got here reads, Leanne, a question on the organic business. With the current revenue annualizing at approximately 35 million, you should be able to generate 4 million of EBITDA from the same. Will that allow the business to be cash generative in the core business?
Yeah, well, first I would say I think we kind of highlighted that it's not necessarily for H2 this year to kind of double H1, so we're cautious on that. But taking those broad numbers, yes, getting back into an annualized and consistent margin and EBITDA across the year, that does start to put the business into a cash generative position.
Alistair, Leanne, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Alistair, could I please just ask you for a few closing comments?
Yeah, so just thank you everybody for your time today. Hopefully this has given you a good update in terms of where the business is and direction going forward, and particularly thank you for the questions, some very good questions in there, but I hope that gives you a bit more clarity, and we look forward to updating you in the near future. Thank you.
Thank you.
Alistair, Leanne, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of TEKMAR Group PLC, we'd like to thank you for attending today's presentation and good afternoon to you all.